Hi, welcome to financialexpress.com Budget 2018 Special Series. The budget is barely 40 to 50 days away, and this is going to be the last full budget of the Modi government before it comes up for re-election in 2019. There are a number of issues right now, right from agri-distress to job growth to GDP growth, particularly after demonetization and after GST. And to answer some of the questions on the economy, we have with us today Mr. Ajay Chhibber, who is Chief Economic Advisor, FICCI. He has an illustrious track record, having served in the World Bank, at the UN, having briefly served at the Indian Planning Commission. He studied at Stanford and at the Delhi School of Economics. Welcome, sir.
Thank you.
So the first question, if you had to tell the economy, you are here on a map, where would the economy be? How would you describe it?
So I would, the analogy that I would give would be not on a map per se, but if you think of a 4-engine aircraft, the economy is running barely on one engine these days, and that is government spending. And there are signs of some revival now, a little bit uptick on exports, although I think it's a base effect. And people say there's some uptick in capital formation. But basically the economy is running on one engine, and if that engine slows down because we have another quarter still left at least, and if the target of 3.2 has to be met, then they will have to rein in government spending also to meet that target. So unless other engines take up, this plane could be, has some difficulties at the moment.
Which leads me to the next question, which is, so GST has just come in. No one can very accurately predict what the government collections on tax would be like.
Right.
Keeping all this in mind and the expenditure that is happening and this one engine that is consuming a lot of resources,
right.
Do you see the government sticking to its numbers in terms of fiscal deficit and the other numbers that it has committed in the previous budget?
It's hard for me to say at this point, but I think it will depend on how much they can rein in expenditure. But also I think on disinvestment, they have probably gone a little beyond the target. So they have some give there. But yeah, it's going to be a very tough act to meet the target of 3.2%. There are even people suggesting that perhaps it's not that important to meet the target of 3.2%. But given that the fiscal finances of the states are not in good shape, there's a lot of borrowing taking place at the state level through public corporations. The position of the PSU itself is also not that great. I mean, the money that was expected to be coming from them. So it's not a time for fiscal ease by any means. But so it's going to be a tough act to meet the 3.2 target, I think.
So the other tough act probably would be job creation.
Right.
The opposition alleges, and there's some data that shows that job growth is not what it should have been.
Right.
The government on its part is saying that the Mudra scheme has generated self-employment.
Right.
And that there is a substantial growth in the number of provident fund accounts and so on.
Right.
So what do you think are the very quickly the most doable steps for job creation over the next 2 years to step this up?
So I think, well, the numbers are very confusing to put it mildly, and there are lots of different numbers, and they're not very good numbers either on the issue of jobs, and I think they should focus on that. That said, if your economy is growing at 8-9% and labor productivity is increasing by 2-3%, then the balance has to be an increase in jobs, whether they are formal jobs or informal work. That is a definitional issue. So if your economy now has slowed down to 6.6%, and if, as is claimed, labor productivity is rising, then I think the rate at which work was being created has certainly gone down, and I think that needs to be stepped up. So there are two things that could be done. One was, of course, to revive the economy, and the other is to ensure that it is less capital intensive, that growth rate that does take place, so that you have more left over for, so there will be less improvement in labor productivity, but more work to be spread around many more people. And so therefore, the best period for us for employment growth and for poverty reduction was actually in the period of UPA 1, when the economy was growing very rapidly. And the quicker we get back to that, the sooner it will be. This will mean a lot of different things. It will mean also, of course, a bigger export drive, a new industrial policy, a focus also on making sure that there's a lot more infrastructure that can draw in private investment, not just corporate investment, but also small, medium scale investment in small and medium industries, and in construction, in real estate related activities. I think those are the big drivers for job growth in this country, and we should get back on track with that. But at the moment, of course, with a slowing economy, obviously the growth in work has slowed down.
Similarly, there's talk of this agri-distress.
Right.
Now, farmers would want higher MSPs.
Right.
That could lead to inflation. RBI is anyway has put a halt to decreasing interest rates.
Right.
So what do you think are the most actionable steps that can happen in Budget 2018 to take this agri-distress away?
So I think, agri-distress is a long-term problem, and that long-term agri or rural distress is a long-term problem because the only long-term solution to this is to get more people out of the rural areas and out of agriculture work into other areas of work. And we have failed to do that. China clearly was very successful in doing that. Vietnam was very successful in doing that. So if you keep 50% of your population in the rural areas, you're going to perpetually have rural distress. Now you can give them a little bit of sops in the budget here and there. You can increase the allocation for Manrega program. You can give higher farm prices for MSP for products. But then if you want to keep the consumer price down, you will have to absorb that in the fiscal itself. So, there are, I would call, band-aids or palliatives that are possible. But really reviving non-farm work is really the only permanent solution to reducing rural distress. Otherwise, you will have these loan melas, loan waivers coming again and again and again. And it doesn't matter which government is there, they all have it. It happened during UPA government also. If you remember, before the 2009 election, there was a big one. So this is the nature of the problem that we are created for ourselves, that we will be perpetually in this situation. So I think, so that is one. But the other is also that we are not allowing the farmers adequate return even on what they are producing, right? So liberalization of agricultural produce marketing, it's been done in a few states, but not in all.
So ENAM and perhaps FDI in food retail.
Food retail would be a big help too, because it will increase the returns for whatever the farmers are producing, which will help certainly in an important way in that as well.
So as an industry body, do you realistically see FDI in food retail taking off? Have all the problems been addressed for investors?
They haven't all been addressed, and therefore, and one of the big issues is this APMC liberalization itself. There is also, of course, a lot of infrastructure related issues of logistics, warehousing, all that. But all that can be brought in by private investment if the regulations are okay, if the zoning systems are changed, then private money can flow into those areas. It's happening to some extent. I'm not saying it's not such a bad story, but this could be accelerated quite considerably. It would also reduce waste quite a lot, because we are wasting about 40%, and we could be down to 20% if we are modernizing this value chain that is now, this farm to fork value chain can be modernized considerably, in my opinion.
So as an industry body, what particular items would you have on your wish list for the economy, for industry, and for trade? Some of the top items.
Well, immediately, of course, the issue is that, the US is about to reduce their corporate taxes by 20% to 20%, and so there will be a huge disadvantage to Indian business. Government had promised that it will reduce from 30 to 25, but that has not happened. So at a minimum, they could move in that direction. There would be, I think, we can't just say, well, we'll fix the GST and we will fix the recap of the banks and few other little things here and there, and we just need to consolidate now, and that will be enough, because like I said, only one engine working. So if there are three other engines, one is private consumption, the other is investment, third is exports. Now, exports have started to pick up a little bit. Global market conditions are actually quite healthy at the moment, but other countries are expanding their exports much faster than we are, right? So there's an issue there as to why our exports are not growing much faster, and part of it is logistics, part of it is cost of doing business here, but part of it is also that in the last few years we have followed a very appreciated exchange rate policy, and we have hurt our own exporters, and we have allowed flood of imports to come in. So that's one. The other is we have had very high interest rates. Now, of course, inflation is picking up, so the RBI can say we are not going to raise interest rates, which is probably the right policy, but we missed an opportunity all these last 2-3 years to lower interest rates considerably. In my opinion, this year they should have gone down by about 100 to 150 basis points more. Then I think, in 1956, we had the industrial policy resolution which turned India inward. In 92, we had an industrial policy resolution that opened the economy, and we benefited a lot from that. But now, 25 years later, in a much more difficult global environment, we need a much more strategic trade and industrial policy in this country. Announcing that in this coming year, whether it's exactly with the budget or not, I think would be a big signal of, the Modi government has done some reforms, but it's still not come out with a clear blueprint of where they are headed, what is their philosophy and thinking of how we will translate Make in India. Make in India was a great slogan, but it still remained more or less a slogan, because there's no concrete steps and policies that have been properly enunciated behind that. So I think it's time, that we you know, when Prime Minister Nehru did one thing, then Dr. Manmohan Singh and Narasimha Rao did that, that now the Modi Sarkar comes up with a, you know, how private sector and government together will work in a strategic way, trade and industrial policy, to take on the rest of the world. We have to increase our exports from around roughly $300 billion to at least $1 trillion over the next 8 to 10 years. How will we do that? And that is the engine that will drive domestic industry, that will create jobs, that will create employment, that will make us a $5 trillion economy by, say, 2025.
So any specific actionable step that you think can be taken that will signal that we're moving in this direction?
So let me take assembly. We have been very successful in assembled automobiles, right? That's one of our areas where we have done quite well. It didn't happen accidentally. There was a AMP, automobile policy, that was there from 2006 to 2016, that we have to reach $150 billion. There was, combined with it, Nat Trips, which said we will put money in R&D so that we become the global center in this category of automobiles. And we have achieved that. Now, of course, many of our cars are going to Africa and mostly to Asia, but even a little bit to Europe. But we have created jobs with it. We could do the same in telecom. We could do the same in electronics. We could do the same in electrical goods. Why not? Why don't we have this kind of a strategic approach to these items? We have done well in aeronautics parts, for example. So it was FDI, like China did. FDI came in, but we had an offset policy there, right? So why can't we do that in 5 other areas? We say, all right, you come, we will be the parts and components supplier for 7 or 8 of these areas, but we want you to come with an offset policy. Come in, bring the FDI in. So we are liberalizing FDI, but we are not matching that with ways in which, how will we then make this in this sector or this industry become a major hub for India for the rest of the world? No. So there are specific things that can be done. I mean, if we had more time, I could go into more detail with you, but I'm just giving you some examples.
So my next question is on infrastructure and labor reforms.
Right.
Now the government has been spending on infrastructure.
Yeah.
The Indian Railways is trying some, what they say are innovative means of financing by borrowing money from LIC. Yeah. So how does the government spend more on infrastructure without compromising the fisc? And number 2, on labor reforms, with elections now barely 1.5 years away, they are unlikely to be very radical labor reforms. But what are, as an industry body, what do you think are the 1, 2 or 3 things that can be done to make the labor environment more conducive?
Right. So on infrastructure, I think, so see, the problem we have ended up with is that because we have of course financing some of our infrastructure from the fisc. Then we said, okay, that's not enough, so let's go for PPP model. That was one model. Then the other is we will have banks lend to infrastructure projects. Now those two have run into some difficulties. Partly because I think the PPP formulation was not right, the risk apportionment was not right, and then there were delays because of acquisition of land, etc., etc. There is a nice committee report by Mr. Kelkar, whose recommendations have just been put on shelf at the moment. That can be looked into. But I think the financing problem is a bigger problem, and which is where the railway LIC thing becomes interesting, which is that banks are not, in no part of the world are they the right financial institution for long-term financing. And we have tried to do that. And we have come up with all sorts of schemes like 5 by 5, 5 by 25. and all that, but it doesn't really work, right? And we have seen the result of that with the twin balance sheet problem that we have now. So the solution is really to go for more long-term sources of finance, which is insurance and bond markets and things like that. So I think from that angle, I don't know the full details of the railway LIC issue, but that's the right way to go. The other way to do it is to say, okay, I have created some existing assets, right? Now those assets are on the ground. I can monetize these assets by bringing private sector to run them and then using that money to build new assets.
It's happening in roads.
To some extent, it's happening in roads also. And the third thing is, of course, they use divestment receipts for the budget. But really, I mean, when you think of balance sheet to balance sheet, the balance sheet of the government is 250 central, say, PSUs, PSEs as they call them. Now, this balance sheet is worth about $500 billion, $400 to $500 billion. So we can get $250 billion there. That balance sheet can be reduced, and that money can be transferred to infrastructure, right? So you get $250 billion here, you leverage in another $250 billion. So you have $500 billion then extra for infrastructure spending. That can be also done. So there are ways to do this, and I think they are thinking along these lines also. Government is thinking, and private sector can play a big part in helping them think through this also. On the labor issue, yeah, it's a complicated issue. So a few states have done this 100 to 300. Rajasthan, Madhya Pradesh, Maharashtra. I know there are state elections, but there are many states where there are no more elections. They have already finished their elections. They can go ahead and even do more radical reforms. The labor reforms has now become more or less a state subject. So it doesn't have to be a big political hoo-ha in Delhi. Every state can do, and some can do more aggressive than what has been done even so far. Their elections are over. They can go ahead. UP election is over. Bihar election is over. Gujarat election just got over. So what is to stop them, right? Their next election is a long time away. And so there is no reason why these states can't move ahead on some of these reforms. And the central government anyway has said whatever reforms they will do, we will approve. They are not going to block them. So it is possible. It is possible. Why not?
Any GST issues that you think should be addressed in the budget?
So GST, of course, the big issue is that now we have to bring the rates or the exempted items back in, because without that you can't really rationalize the current GST. Now for petroleum you can have GST plus you can have add-ons, because the tax rate on petroleum is much higher than any reasonable GST rate, right? But reasonable GST rate should be around 18%, but then you can add on extra for revenue purposes. I think now that there is more cohesion in the GST Council and more trust with each other, a lot of these issues can get solved in the coming year or two. But that's the direction in which the finance minister has already signaled that he would like to go. I think many members of the GST Council who actually spoke at FICCI the other day, 3 chief ministers were here from Bihar, from Jammu and Kashmir, and from West Bengal. They all said that we would be amenable to move in this direction as well. So I'm quite hopeful that we may look back after 5 years or 10 years of GST as a teething problem that took place. More teething than we would have liked, but in the long run, I think this tax is a real reform, and it will increase our revenue base. It will also unify the market much more. But at the moment, of course, we are facing a lot of difficulty. We are getting a lot of feedback from our membership also on difficulty, particularly for the small and medium sector.
So last year the budget was pushed forward to February 1st.
Yeah.
The idea was to spend much better.
Yeah.
And now there's talk of the calendar year being made the financial year.
Yeah.
So do you think bringing the budget forward has led to better outcomes, and should we switch over to calendar year as the financial year?
I think bringing the budget forward is very good, because I remember I spent 1 year in government, and the budget gets announced, but you don't even get to see that money for another 3-4 months. And then you start thinking about how to spend it, right? So bringing the budget forward, but not the spend year, gives you that time between 1st of February and end of March to start planning the next year's expenditure. So this is a very good thing. On the calendar year, I don't see it making such a big difference. I mean, it will align us more with what's happening in the rest of the world. But per se, I don't see that as a game changer in any particular way. And given that we have Diwali and all those things, so I'm not sure that I think changing India to 2 time zones rather than this half-an-hour business that we have will make a big boost to the eastern part of the country, because it gets dark very early in the eastern part of the country. So if the government is keen to develop the northeast and the eastern part much more, then rational thing would be 2 time zones with a 1 hour difference. I mean, USA lives with 3 time zones, the Russians live with 7 time zones. The Chinese also have, I think, 3 time zones. So for a big country like ours to have 2 time zones is not a big thing. I think the productivity announcement is huge, not just for government, but for society and for business, for schools, for children, for economic activity, for, that would be a game changer. Calendar year, fiscal year, I don't know. I don't think it's such a big deal.
Thank you for those wonderful insights, Mr. Chhibber. With 1.5 years to go, there isn't enough time, obviously, for game-changing or very long-term reforms. But surely a number of steps can be taken to get more than one engine firing over the next 18 months. Thank you.